Start off by documenting assumptions on what appears to be a capital investment in camera equipment that will allow me to produce photography services. So the first thing that will be needed will be a camera which costs $3,000. The camera needs lenses to go with it, each of which is $2,000, for which the quantity of lenses that I'm going to buy appears to be 5. Additionally, we need cases, each of which is $150, of which we'll buy 7 of those. The useful life of the equipment, as measured in years, will be 5 years. And there's no cash value associated with the end. These would all appear to be balance sheet related items, as they are the long-term investments that I need so that I can then start doing my shoots. I'll do 10 shoots a year at an average of $1,000 per shoot. This looks like then income statement related items, which will allow me to generate the revenues that I need, and revenues will come for each shoot, for which I'll do 10, and then the price per shoot will be $1,000 per as my fee. Now, to be able to do shoots, it's going to take some degree of expenses as well. So let's label these as revenues, indent them a little bit, and now let's think of our expenses as being in 2 categories: our cost of goods sold and our SG and A. Ultimately, as a finance person, we care more about the cash flows than the accounting. So whether or not we put the expense items in the right category won't hurt us, but let's, for the purposes of this, assume that the SD card per shoot is a cost of goods sold item, as is our assistant, who's going to get paid per shoot $300. And then that way we can assign those to cost of goods, where we will assume that the Ubers, which per shoot appears to cost me $100 on a per shoot basis. And then the other 2 expense items for which I'm always concerned, the one that has to do with our purchase of capital items, would be depreciation expense. And then, of course, we will have tax. And the tax is 20%. How will we go ahead and calculate depreciation? First thing we need to do is sum up all of our capital items. So there's our camera, plus lenses, for which we buy 5, plus then cases, for which we buy 7. So the total amount of our expenditures is $14,000 and change. If we divide that then by the number of years of useful life, which is 5, tells us we'll have just over $2,800 in depreciation. Let's go ahead and use this information to calculate out a 5-year income statement. We'll start the income statement in year 1 in column C, so that we free up column B to do our cash flow period 0 later. Crank out the income statement. We have revenues, we have expenses, we have cost of goods sold, we have gross profit. Gross profit then minus SG and A gives us EBITDA. EBITDA minus depreciation expense is going to give us EBIT. EBIT minus interest expense will give us EBT, from which we'll subtract tax, and we'll get the amount of profit associated. Because this information is documented in assumptions and it stays fixed for the whole time, I'm going to use a lot of the dollar signs to affix rows and columns. So my revenues are going to be 10 shoots per year, fix it, times $1,000 per shoot, fix it, there's my 10,000. Cost of goods then is going to be equal to SD cards, fix it per shoot, times my 10 shoots, plus my assistant. I want to go ahead and fix that last reference too before we move on. plus then my assistant, who makes $300, fix it per shoot, times my 10 shoots. Got 10 shoots here. F4 tells me then I have $3,500 in cost of goods. Profit then will be equal to my revenues minus my cost of goods sold. The SG&A we said we would assume would be Uber's, fix it, $100 per shoot times my 10 shoots. Fix that too. Gives me $1,000 worth of Uber. So my EBITDA is gross profit minus SG&A. Depreciation expense we calculated above at 2810. Fix that reference so that our EBIT is equal to EBITDA minus depreciation. Interest expense was indicated as none, so our EBT is EBIT minus interest. Tax is going to be 20% of the earnings before tax, also known as taxable income. So we'll pay $538 in taxes per year. Thereby my net income will be just over $2,100 per year. Now that we've done one column right and have fixed all our references, we should be able to just go ahead and copy and paste this for my 5 years because nothing changed. Notice that this number didn't update. Why is that? I should have fixed the tax reference there to the 20% that's up above. Now my numbers tie out. Looks like I have $2,000 worth of profit per year. Now let's build out our NPV model. So when we do the periods, we start with period 0. We're going to run through 5 years. We had a rate somewhere. I don't see the rate up above. All right, I'm going to go ahead and just assume a rate of 8%. And we'll update this in the problem for you. Assume a discount rate of 8. And this will let me complete my NPV model. So the cash flows in, then the cash flows out, gives me the cash flows net, for which I'll calculate my PV, my NPV, and my IRR. So the cash flows in are going to be equal to my revenues. My cash flows out are any cash expenses like cost of goods, like SG&A, not depreciation, but interest expense if there was any, and then tax. Cash flows net is just equal to in minus out, for which then we can calculate a present value using the rate up above. We'll fix that the way it looks in a minute, but we'll hit F4 since it doesn't move. This particular cash flow would be 1 period away. There's no payment, so I double tap to get beyond it. Then I'm going to switch the sign on the future value so that it shows me as a positive, and then the future value will be my cash flows net, so that $4,962 worth of cash flows net that would come in 1 year at a rate of 8% is worth like $4,594 a day. We can copy and paste that across. Notice that as the future value grows into future periods, the present value declines. The whole reason that we could do this is we had to buy all this equipment, which included a camera plus 5 lenses plus 7 cases. There's that original 14,000, which shows us then at the beginning of our entire investment period, it cost us $14,000 to produce these cash flows, which if we copy and paste that, we can see it's a negative original cash flow. The NPV then is just the sum of all those present values. So I have a positive NPV, and then the IRR is a built-in Excel formula equals IRR. We point to the cash flows net, and we see we have a nice positive 22.53% rate of return associated with becoming a photographer who would then take pictures for the university in what would be a positively profitable NPV project.